This is Nightly Business Report with Bill Griffith and Sue Herrera.
What's next? Stocks are sitting near new highs, but is the sharp rally since the start of the year sustainable? The big fix. A CEO wants to fix the nation's infrastructure, and he says companies should pay, not taxpayers. Rising risks to real estate. Why a Louisiana town literally moved itself to higher ground. Those stories and much more tonight on Nightly Business Report for this Wednesday, April the 24th. And we do bid you a good evening, everybody, and welcome. Sue is off tonight. Well, the powerful stock market rally of 2019 took a breather today, one day after the S&P 500 and the NASDAQ composite closed at record levels. Earnings from some very big corporations were not enough to push stocks higher in today's session. And by the close, the Dow Industrial Average was down 59 points. We're at 26,597. The NASDAQ was down 18. The S&P slid by 6. But look at how the market has come this year so far. The Dow, the S&P, the NASDAQ, all up double digits. And 4 sectors have gained 20% or more, led by information technology. But is the rally sustainable? Bob Pisani takes a look.
We are not out of the woods just yet. Earnings season has been, for the most part, pretty positive. Companies are beating by much wider margins than they usually do. Beyond the earnings beat, we see some signs of the slowdown in China bottoming out. Europe is showing at least some signs of stability. It's not out of the woods either. And a still very patient Federal Reserve. Well, it's pretty good news overall. The question is, what's next? So we've now heard from the banks. They have been okay, not great in their earnings. Industrials have been pretty good overall. And a smattering of consumer names like Kimberly-Clark and Procter & Gamble also have been better than expected. So to keep the momentum going, we need to hear now from different sectors. First off, from technology. That's the main play on global growth. Then second, from energy names like Chevron and Exxon on Friday. Oil prices are now above $65 a barrel. That was $50 in the end of December. And especially we need to hear from healthcare. Remember, suddenly that's become the market's problem child. Healthcare is the second biggest sector, making up 16% of the S&P 500. And remember this Medicare for All thing? That's thrown a monkey wrench into long-term earnings. But equally important is the Democrats promising hearings on drug prices in general. So we definitely need to hear from Pfizer and from Merck and from Eli Lilly and what they've got to say about how that's going to impact them. And what else is missing from this rally? Volume and volatility. If you think Wall Street's celebrating, try calling around on a trading desk. You're not going to hear any champagne corks popping about new highs. The stock traders want to see more serious action. Nobody's scrambling to buy stocks. The volume's still low. And overall, the volatility isn't that high either. The rally also needs to broaden out a little bit. It was a little better today, but the market is being pushed up by a small group of super performers. We need more stocks at new highs. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Let's turn now to a market bull and a bear, sort of, for their thoughts on where the markets may be going from here. Our bull is Kevin Carone, Senior Portfolio Manager at Washington Crossing Advisors, and our bear, in quotes, air quotes, that would be David Sowerby. He's Portfolio Manager at Ancora Advisors. He's a bit more cautious, is the better way to put that. Hi, guys. Good to see you. Kevin, make the bull case for this market at these highs.
Well, the bull case is that the U.S. continues to be very strong. We're looking at 3% growth, which is a big pickup over where we were a couple of years ago. And the data during the quarter has gotten much better. So manufacturing is looking better here and in China. And valuations seem to be relatively reasonable to us. And with the bond market rally and the Fed moving to a more cautious or patient posture, to us, it looks like the returns on stocks are relatively more attractive.
All right. David, why are you cautious right now?
Sure, Bill. Stocks we know have rallied 25% from the December 24th lows. At the same time, you and I like to talk about investor sentiment. At year end, 50% of individual investors said they were bearish. Only 21% say they're bearish today. I think that means that markets have gotten a bit ahead of themselves. Earlier small cap stocks were very much pacing this rally. Since early March, they have not kept pace, both small cap and even the more cyclical micro caps to their large cap siblings. And finally, valuations have expanded by about 18 percentage points. They usually expand about 20 percentage points, 20% in a rally off the lows. Having said all that, on days like today, in portfolios, I've been taking some profits and dialing back my stock exposure.
All right. Kevin, what about some of those, especially when it comes to sentiment, the volatility index, the fear indicators, very low right now. Is that complacency for this market?
Well, not really. It's been bouncing around, and I think Ron Pisani just highlighted some ideas that sentiment is kind of in the middle ground as far as we can tell. There is a better mood out there today. Certainly, you see it in the IPO market, for example. You see it in the rally in stocks. You see it just broadly speaking. But remember, where we were 6 months ago was a very different, more pessimistic place. So when you average it all together, we think that the typical investor is still somewhat cautious and not overly ebullient. And that's a good thing for the market going forward.
And David, the huge sell-off we saw in the fourth quarter of last year, largely the fear was that we were seeing a slowing global economy and that the Fed was raising interest rates. Neither of those seems to be happening right now. Why isn't that a green light for this market?
And from the Fed's perspective, the fact that the Fed is at least on hold, I think is a good thing for what's transpired already in the stock market. But when people start to talk about, will the Fed reduce interest rates, I think that's simply rubbish. Inflation is still going to be, I think, more of an issue than not. That causes the Fed to still have to embark on a tightening mode. If not this year, early next year. That begins to bring stocks into question again in a period of rising interest rates and Fed tightening. I think that's why you want to take a little bit of profits here, knowing that so much of the gains have already transpired.
Very good. Thank you both. Kevin Carone with Washington Crossing Advisors, David Sowerby with Encore Advisors. Good to see you both.
Bill.
Thanks.
Thank you.
Now to all those earnings reports that were out today, starting with Microsoft, which traded near record highs in extended hours tonight after the Dow component reported better than expected revenue thanks to growth in its cloud business called Azure. Stock was up smartly in the after hours tonight. Josh Lipton has the one key takeaway from Microsoft's results.
Microsoft doesn't disclose revenue for Azure, its cloud computing division, but it does break out how fast that division is growing. In its latest earnings report, Microsoft said Azure grew 73%. Dan Ives of Wedbush says that was the big number for him, showing that Microsoft's cloud story is really still in the early innings of playing out, he says, and it was better, he notes, than many on the street were looking for. Microsoft's commercial cloud business, which includes Azure, grew more than 40% to $9.6 billion. For Nightly Business Report, I'm Josh Lipton, San Francisco.
Then there's Facebook, which reported a rise in revenue thanks to growth in its Instagram platform and an increase in ad spending. Company, though, also announced a multi-billion-dollar legal expense related to a privacy investigation being conducted by the Federal Trade Commission. Stock rose in initial after-hours trading tonight, though. Julia Borston has more on Facebook's quarter.
A big headline out of Facebook that had nothing to do with its user growth or advertising. $3 billion. That's the size of the legal expense Facebook took related to the ongoing Federal Trade Commission inquiry into Facebook's data practices, estimating that the company could take a loss between $3 and $5 billion. Facebook warning that the matter remains unresolved and there can be no assurance as to the timing or the terms of a financial outcome. The issue at hand, back in 2011, Facebook settled with the FTC over charges it deceived users by telling them they could keep their information private. This inquiry started after the Cambridge Analytica scandal broke last year, and it's looking into whether the company violated its commitments to the FTC. But investors seem assured that excluding that charge, growth on the top and bottom line exceeded expectations. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Visa reported a double-digit rise in profit as more people use their credit cards, increasing Visa's swipe fees and processing transactions. The Dow component has benefited from the tight labor market and the increase in wages, but Visa's revenue was just in line. And that created volatility, as you can see in the stock in the extended hour session tonight. Investors were hoping that Boeing's earnings would answer some questions about the financial impact of the grounding of its 737 MAX planes. Now, here's what we learned today. Quarterly results did meet expectations, but the company is taking a $1 billion hit and suspending guidance for the rest of the year. Despite that, the stock did finish with a fractional gain tonight. Phil LeBeau has more.
Boeing 737 MAX, grounded around the world following 2 crashes that killed more than 300 people, is weighing on the company's bottom line. With MAXs being built but parked until deliveries can resume, cash flow is slowing down, so Boeing is suspending its share repurchase program. Boeing CEO won't give a time frame for when the MAX will fly again, but he says the company is making progress fixing the plane.
We are taking a disciplined approach, completed our technical flight testing last week, and look forward to completing near-term milestones leading to final certification. We are committed to ensuring all who operate the MAX are fully prepared when the grounding is lifted and the fleet returns to service.
The MAX grounding and delaying of deliveries is adding another $1 billion in costs for Boeing, an amount it will account for over the life of the MAX program, which will likely be well into the next decade.
They measure their accounting in decades, not in years. So this airplane is going to get fixed. I think they're on track to the schedules that I've seen. And of course, they've got to get consensus with other regulatory agencies throughout the world. So it's a bigger program than just getting the FAA to buy on it.
The question for airlines is whether passengers will refuse to get on the MAX when it's cleared to take off again. The 3 U.S. airlines flying the MAX are all confident they can reassure passengers the plane is safe.
We are not letting our customers and our employees on an aircraft that we don't find safe, and so we'll have to reassure them. If people do have concerns, we will always take care of our customers in some way.
United has pulled the 737 MAX from its schedule at least until early July. By then, it hopes that it has been recertified and cleared to take off again, and then it will be gradually worked back into the schedule. Phil LeBeau, Nightly Business Report, Chicago.
Caterpillar reported better than expected earnings and it raised its forecast, but higher costs dented margins in its construction business. And that, along with other issues, sent shares of the Dow component lower. Morgan Brennan has details.
An earnings beat for economic bellwether Caterpillar as revenue jumped 5% on higher demand for mining and construction equipment. Mining was the bright spot as revenue for that unit soared 18%. But the main focus of investors? Construction sales, CAT's biggest segment, which climbed just 3%. In the U.S., infrastructure spending at the state and local levels helped fuel demand. But business in China was once again a source of weakness, as Caterpillar now grapples with more pricing competition there.
Spring season, as you know, is usually a strong selling season in China, and it was stronger than normal across the whole of the sector, mainly due to the timing of Chinese New Year. But there's also been some very competitive pricing, and that has had some impact on our relative market shares. Our expectation for the industry for the full year is for China to be up. We expect our sales to be flat-ish for the year.
China accounts for 10% of CAT's overall revenue, so the comments worried investors. The company also raising guidance, but due largely to tax benefits, while higher costs for labor, freight, and some raw materials pressured margins. Taken all together, shares of the Dow component fell in trading today. But the bottom line in an uncertain earnings season? Based on Caterpillar's results, at least some corners of the global economy may be stabilizing after signs of slower growth earlier this year. For Nightly Business Report, I'm Morgan Brennan at the New York Stock Exchange.
Time to take a look at some of today's upgrades and downgrades. We begin with shares of Best Buy. They were upgraded to buy from hold at Jefferies. The analyst cited the company's plans to become more of a service provider in addition to being an electronics retailer. Price target $88, and today's shares closed up at $74.69. Procter & Gamble was upgraded to overweight from equal weight at Barclays. The analyst cited the company's growing market share globally. Price target $112. P&G finished a fraction higher at $103.69. Still ahead, should companies foot the bill for fixing our nation's crumbling infrastructure? And is it even possible? Ford is investing $500 million in electric vehicle startup Rivian, which has plans to begin producing a pickup and an SUV by the end of next year. Ford is hoping this partnership will accelerate its own push into the electric vehicle market. A bidding war may be brewing for Anadarko. Occidental Petroleum today offered $76 a share for the company, topping Chevron's recent offer. Today, in a CNBC interview, the CEO of Occidental made her case.
We are the right acquirer for Anadarko Petroleum because we can get the most out of the shale. We have a lot more experience there. We're performing really, really well. And what hasn't been talked about very much is that the upside in this deal is the shale play, is the shale development. 75% of the value of Anadarko is in the shale. And we're the best company to develop the shale.
Anadarko said it would review this new offer. In the meantime, analysts were speculating today that Chevron will sweeten its bid. Anadarko rose sharply today, as you can see, while Occidental and Chevron fell. The CEO of biotech company Regeneron has an idea on how to fix the nation's aging infrastructure. In an op-ed piece in today's New York Times, Dr. Leonard Schleifer proposed that for the next 3 years, every American public company should issue 1% of its equity to a newly formed infrastructure bank that would be used to fund construction projects. Dr. Schleifer said his idea would raise $1 trillion, and he explained his reasoning during an interview today.
If you walk around our labs, we have some of the most innovative people in the world. And we, as a company, like to provide them with great infrastructure so they can be maximally innovative. I think our country's the same way. We have great potential, but our infrastructure is holding us back. And so I'd like to see that improved.
Joining us to respond to Leonard Schleifer's idea, we are pleased to welcome back William George, himself the former CEO of a publicly traded company, Medtronic. He's now a senior fellow at Harvard Business School. Bill, always good to see you. Thanks for joining us tonight.
Good to see you, Bill.
You're not exactly enamored of this idea. Why?
No, first of all, I have great respect for Leonard Schleifer and his partner, Roy Vagelos, and what they've done at Regeneron. They're great medical scientists, and they should stick to their knitting and do medical science. Infrastructure is the role of the government. Let's not let the politicians off the hook, whether you're talking federal, state, or local government. That's the job of government, to build bridges, to create roads, and make everything run smoothly. And if the business start trying to fund their own infrastructure, we're going to have a mess on our hands, and it's going to be a big game of chicken. So I'm not in favor of this idea, and I don't think we should tap into corporate coffers to pay for it either.
All right, let me play devil's advocate on a couple of areas here. The idea of using some of the cash that's on the coffers in corporate America. I mean, there's tremendous cash out there right now that they're using to buy back shares or pay dividends or whatever. And by some estimates, the infrastructure bill would be about $4.5 trillion. So local governments would have to either do deficit financing or raise taxes. Neither of them very popular. Why not use some of that cash to rebuild the infrastructure?
It's not theirs to use. This corporate cash, say at Regeneron, if they have excess cash, they ought to be spending it on research and development. They're doing some breakthroughs in gene therapy. That's where the money should be going. And frankly, everyone knows drug prices are very, very high, and most Americans can't afford drug prices. So why don't we use them to create sliding scales to get drugs to people that can't afford them? Why don't we use the cash to finance people's drugs and give them a loan program? My former company, Medtronic, has done that in countries like India. It can be done. So I would much rather see them put their cash to work and stick to their knitting in areas where they're successful. And let me give you an example, Bill. Here in Minnesota, we have the same problem. We have an infrastructure problem. Our new governor, Tim Walz, has stepped up and he said, we're going to put on a 20-cent a gallon gas tax. I think that's a great idea because that will also deter too much use of gas and will help the environment. But more importantly, it will fund our infrastructure. And that's exactly what we need to do. And I think the businesses here locally will support that. And I would hope they would, too, between New York and New Jersey.
I'd love to hear from the drivers paying that extra tax. But what about his contention? And this is well beyond Regeneron. Or even the biotech industry, that companies have a vested interest in improving the infrastructure to attract talent and to have the facilities be more amenable to their surroundings out there. What do you think?
They should put their money into facilities. They should reskill their workforce. I'm very concerned. The biotech companies and all the drug companies and hospitals are going to go heavily into AI. We need to reskill the workforce at AI era. That's an area where they don't have to wait for the government to do it. I think we need to let the government do what it's supposed to do, which is infrastructure, national defense, and help poorer people in our country, and particularly with health care. And I think these people should focus on what they can do well. It's having a skilled workforce, up-to-date modern facilities, very advanced technology, and heavy investment in R&D. And I think they will continue to be leading the world with their drugs if they do that.
And there's the other side of the story. Bill, as I said, always good to see you. Thanks for joining us tonight.
Thank you.
Bill George, Harvard Business School, former Medtronic chairman and CEO. More AT&T subscribers pull the plug on DirecTV, and that's where we begin tonight's market focus, with AT&T missing revenue estimates for the first quarter due to, in part, a bigger than expected loss of DirecTV subscribers. The company did, however, report an increase in wireless customers, and they also said it would pay off 3/4 of the debt it incurred or took on in the Time Warner acquisition. They will pay that off by the end of the year. Today, the stock dropped 4%, though, to $30.79. Health insurer Anthem topped quarterly forecasts with strong membership growth and the expansion of its clinical and specialty services. The company also raised its full-year forecast, and the stock today was up a fraction to $251. Northrop Grumman's earnings topped analyst forecast, but revenue did miss. The aerospace and defense giant saw stronger sales in its aerospace unit, but a decline in technology services. The company did raise full-year guidance, though, in the process, and the stock fell more than 4% today to $280 even. Then after the bell, Chipotle topped quarterly earnings and revenue expectations. The Mexican food chain has been focusing on driving sales through online ordering, and already digital is accounting for 15% of the company's sales. The stock was volatile in after hours tonight, but closed the regular session up 1% to $709.95. Also after the bell tonight, Tesla reported a wider than expected loss. Revenue was also light, and the company reaffirmed its guidance for deliveries for this year. The stock was very volatile in initial after-hours trading tonight. Coming up, why residents in a small town in Louisiana are being referred to as America's first climate refugees. Increasingly extreme rainfall is causing chronic flooding in parts of the United States, making some neighborhoods just uninhabitable. Well, the state of Louisiana has come up with an idea. It is using federal funds for an experiment that could turn into a blueprint for dealing with what some are calling climate refugees. Diana Olick explains in her continuing series on the rising risks to real estate.
At a small church meeting house, in a small Louisiana farm town, a small community is making a very big decision.
The option to purchase has been signed. It was signed today.
The community, up to 40 homes, is moving together to higher ground. The state of Louisiana is using federal funds to purchase land, build new homes, demolish the old flood-damaged homes, and turn this neighborhood into wetlands.
So you're going to knock down all of these houses and these as well?
Right.
Pat Forbes, who administers community development block grants for disaster relief, is in charge.
It's quite clear that we're having more disasters, and consequently, we have to start doing things that are smarter. One of the easiest, smartest things you can do is get people out of harm's way.
Pecan Acres was built in the 1970s near a canal, but in the last decade it has seen more frequent and intense flooding. Its levee is no longer adequate. Back-to-back floods in 2016 and 2017 drew the governor's attention, and a plan was hatched to buy out the homeowners and move them here, barely 2 miles away, but 10 feet higher. Cornell Jackson was eager to hear the details. She raised her children and now her granddaughter in the home that recently flooded beyond her financial ability to repair.
So the water came up to about here, and then you had to take that drywall off. Yeah.
You're losing everything. You don't have time to pick up anything, and it just, you got to go back and just start all over again. I mean, it's just miserable.
The program will buy out each homeowner, but since these damaged homes have so little value now, homeowners will also get forgivable loans, up to $200,000 to buy into the new community. For each year they live in their new home, they get 1/5 of the loan forgiven. In 5 years, the home is theirs, debt-free. The cost, roughly $8 million. In the past, the federal government has given flooded homeowners money to simply relocate. But this is one of the first plans to move an entire community en masse here to higher ground. And it could be a model for the future.
When we get done with this, we and everyone else will know more about how to do this and more about the mistakes to avoid than we know right now.
We all in it together, and I'm just not happy for myself, but I'm happy for everybody else, because we done been through a lot.
And you're ready to go.
I'm ready to go.
For Nightly Business Report, I'm Diana Olick in New Roads, Louisiana.
And before we go, a final look at the day on Wall Street. No records today. The Dow was down 59 points, NASDAQ down 18, the S&P down 6. That is Nightly Business Report for tonight. I'm Bill Griffith. Thanks for watching. See you tomorrow.